Welcome to this explainer from FinBot Insights.
For many investors, this is the primary objective, and the fixed income market is often the first port of call for achieving that goal.
To make truly informed decisions in this space, it is crucial to possess a firm grasp of the fundamental principles. Let us begin with the most basic question of all. So, what precisely is a bond, and what role does it play? At its core, a bond is a sophisticated IOU. It is a debt instrument issued by an entity, such as a government or a corporation, to raise capital. Unlike a traditional loan between two parties, a bond allows one borrower to source funds from a wide array of investors at the same time. An investment in a standard bond generates returns through two distinct cash flows. First, the investor receives regular, fixed interest payments over the life of the loan. Second, when the bond's term concludes at its maturity date, the investor receives the original principal back in full. That term, coupon, actually has a rather fascinating physical origin that speaks to the long history of finance.
This tangible history explains why we still refer to a bond's interest payment as a coupon, even though the entire process today is overwhelmingly electronic.
Now that we have established the basic mechanics, let us explore how a bond's return is determined in the open market. This is where the critical concepts of price and yield come into focus.
A fundamental concept for any bond investor is the inverse relationship between a bond's price and its yield. You can visualize it as a seesaw. When prevailing interest rates in the broader market rise, new bonds are issued with more attractive, higher coupons. Consequently, older bonds with lower fixed coupons become less desirable, and their market price must fall to compensate and attract buyers.
This inverse relationship determines whether a bond trades at a premium, a discount, or its original par value. If a bond's fixed coupon rate is higher than current market rates, it becomes more valuable and will trade at a premium. Conversely, if its coupon is below prevailing rates, it will trade at a discount.
This leads us to the most comprehensive measure of a bond's return, the yield to maturity, or YTM. It calculates your total annualized return, factoring in all future coupon payments plus any capital gain or loss you will realize at maturity based on the price you paid for the bond.
Of course, the promise of income is never absolute. It is always accompanied by risk. Understanding these risks is absolutely essential for any successful fixed income investor.
For bond investors, these risks can be broadly categorized into two main types. The first is default risk, which is simply the chance the issuer will fail to pay you back. The second is interest rate risk, which we have just discussed, the risk that changes in market rates will negatively affect the value of your bond.
While interest rate risk is a market-wide phenomenon that affects all bonds, default risk is entirely specific to the issuer. Fortunately, a formal system exists for assessing it.
These specialized agencies provide a standardized framework for comparing the relative safety of different bonds. They conduct in-depth analysis of an issuer's financial condition and assign a grade that acts as a convenient shorthand for its overall creditworthiness. The agencies assign ratings along a clear scale, providing investors with a quick assessment of an issuer's ability to meet its debt obligations. The highest quality issuers receive a AAA rating, with default risk increasing as one moves down the scale.
This rating scale is bisected into two main categories. Investment-grade bonds are considered to have a relatively low risk of default. In contrast, speculative-grade bonds, often called junk bonds, must offer higher potential yields to compensate investors for their substantially higher default risk.
This chart illustrates the real-world significance of these ratings with striking clarity. Looking at historical data, the probability of an issuer defaulting increases dramatically as its credit rating declines. The risk for the lowest-rated bonds is exponentially higher than for those at the top of the scale.
Armed with this understanding of return and risk, we can now survey the landscape of the entities that actually issue these bonds.
Although the bond market is vast, most issues fall into one of three primary categories. Government bonds are backed by the full faith and credit of a national government. Corporate bonds are issued by companies to fund their operations and growth. And municipal bonds are used by local governments to finance public works. Ultimately, every income investor must navigate this fundamental trade-off. The principles we have covered, from coupons and yields to default and interest rate risk, provide the essential framework for you to make that assessment for your own portfolio.
Your support enables us to create more content designed to empower you in the financial markets. Thank you for watching.